Unable to plan for their long-term future, UK businesses have focused on short-term Brexit contingency plans. Concerned about disruptions to trade given the potential March 29th cliff edge, companies on both sides of the Channel brought forward production, pushing goods imports and exports with the EU to decade highs in the 3 months to February, despite the doldrums in both economies. According to our agent surveys, the proportion of UK firms with contingency plans in place has risen from about a half in February to around 3/4 at present. And stock building has been central to the plans of over 2/5 of those firms, boosting GDP in the first quarter. Nevertheless, it remains that companies are only as ready as they can be, and they expect a marked decline in the rate of growth, investment, and employment in the event of a hard Brexit. In recent surveys, firms expected their output would fall by 3.5% in the event of a no-deal, no-transition Brexit. Faced with the high option value of waiting for news about Brexit, companies in aggregate appear to have favored hiring over capital investment. As a result, the UK labour market has outperformed expectations over the past year, with employment and wage growth both surprising on the upside. The resulting strength in real income growth has supported consumption, which in turn has driven domestic demand. Four-quarter real income growth picked up further in the first quarter, and surveys of consumer confidence indicate that households remain relatively optimistic about their own personal financial prospects, despite being pessimistic about the overall economic situation. And that divergence may be one reason why the only area of household spending that is discernibly restrained by Brexit is the housing market, where transactions are currently somewhat subdued and prices are stagnating. In aggregate, first quarter growth is projected to come in 0.3 percentage points stronger than we had projected in the February inflation report. About half of that upside surprise could be due to the boost from Brexit-related stock building. Consistent with reports from our agents, the MPC expects a corresponding drag in the second quarter. Smoothing through this volatility, the underlying pace of growth is a touch stronger than the MPC had previously assessed, though it's still a little below potential, meaning that the current margin of slack in the economy is expected to widen a little in coming quarters. While financial markets remain sensitive to Brexit-related news, global developments appear to have driven the market curve for bank rate that underlies the MPC's projections. Expectations of policy rates in the United States and the euro area have fallen significantly since February, and market expectations for the path of bank rate have followed. That path currently implies that bank rate will rise to around 1% by the end of the forecast period, around 15 basis points lower than in the February report. As the MPC's inflation forecast suggests, this new market curve introduces an additional financial market tension to the one that already exists between the current level of sterling and the level that would be consistent with whatever Brexit outcome ultimately comes to pass.